You won't believe how simple this is to do. You will definitely want to watch to the end so you can learn all the ins and outs on how to do a backdoor Roth IRA conversion. Let's get going. Roth IRAs stand out as some of the best accounts you can have. They offer the perk of tax-free growth on your investments indefinitely. When you retire, you can withdraw funds from your Roth IRA completely tax-free. Not only that, but Roth IRAs also spare you from required minimum distributions or RMDs and don't factor into Social Security income tax calculations. The list of advantages goes on. However, there is a catch. The IRS restricts your contributions if your income exceeds certain thresholds. This limitation can push you towards other taxable accounts, but don't be afraid, there is a solution. Today, I'm going to dive into how you still might be able to contribute to your Roth IRA even if you surpass those income limits. All right, let's break down the numbers for 2024 regarding Roth IRA eligibility. If you're single, your modified adjusted gross income, which is essentially your gross salary minus any contributions to your 401k or 403b plans, needs to be under $161,000. For those filing taxes as married filing jointly, if your combined income is less than $240,000, you're also eligible to make a Roth IRA contribution. If you fall within these income brackets, you can contribute directly to a Roth IRA without any complications. No need to worry about the rest of this video, you're good to go. However, if you find yourself in another situation where you're single and your income is over $161,000, or if you're married and your combined income is over $240,000, you'll face restrictions on making a full Roth IRA contribution. If this is the case and your income exceeds these ranges, you still might be able to do a partial contribution, but the amount you can contribute will gradually decrease as your income rises. Now let's focus on a solution for those of you who exceed the income limits. How can you still take advantage of the fantastic tax benefits offered by Roth IRAs? Well, here's what you can do. You can initiate a powerful strategy that's known as a backdoor Roth conversion. However, it's super important to understand that this way has its own set of rules, so please watch until the end of the video because it might not be suitable for everyone, and there are common mistakes to avoid. If you're looking to contribute to an IRA or a Roth IRA in 2024, the contribution limit is $7,000 or $8,000 if you're 50 and older. But if your income exceeds these limits, as we've said before, you can't directly put money into your Roth IRA. You also cannot make deductible contributions to a traditional IRA, meaning that you will not get a tax break on those contributions. Right from the start, it might seem like you're out of luck. It can feel like a Roth IRA is for someone else, but not for you. But here's where the concept of a backdoor Roth conversion comes into play. Instead of depositing your contribution directly into a Roth IRA or a traditional IRA with tax deductions, you can channel your contribution into a non-deductible traditional IRA. And if you convert the balance from your non-deductible IRA immediately into your Roth IRA, you're essentially changing $7,000 of after-tax dollars into another after-tax dollar account. Unlike a pretax IRA that could have been a traditional IRA contribution you deducted in the past, or a rollover from a 401k when changing jobs, converting it to a Roth IRA in this case means any amount converted would be fully taxable. However, because you did not take a deduction for this traditional IRA contribution, you can immediately convert it into a Roth IRA and you can avoid taxes on the conversion. So essentially what you're doing is splitting up a process that would normally be a single-step process into a two-step process. It sounds pretty straightforward enough. You can open up an IRA, make a contribution without taking a tax deduction, then immediately convert it, and then finally invest the funds in your Roth IRA. Here's a key point to discuss though before we go any further. Even though there are income limits on Roth IRA contributions, there aren't any limits on Roth conversions. You can earn as much as you want and still convert a traditional IRA with no deductions to a Roth IRA. However, there are nuances. Here are some details that can trip people up and lead to trouble. Now, I can imagine you're watching this video and you're thinking, this is fantastic. I already have another traditional IRA, but I'll just open a new one to make this non-deductible contribution and take advantage of the backdoor Roth conversion. Let's make some simple assumptions for illustration purposes. Suppose you already have a pre-tax IRA with a balance of $24,000 fully funded and operating. Now you're eager to pursue a backdoor Roth strategy, and to do this, you open up a separate IRA on the side and make a $6,000 non-deductible contribution. We will use $6,000 instead of $7,000 to make the math easy. At this point, you have $6,000 in your non-deductible IRA. The next step is to convert this amount into your Roth IRA, allowing the funds to grow tax-free indefinitely. However, the IRS will view this process far differently. The IRS applies what's known as an aggregation rule in this scenario. They assess all of your IRA accounts, treating them all as if you have one sizable $30,000 IRA, not two separate $24,000 and $6,000 IRAs respectively. So here's what happens. The IRS will treat it as $30,000 in IRAs, of which 80% is pre-tax. In other words, $24,000 divided by $30,000 equals 80% pre-tax and 20% after tax, considering the new non-deductible contribution. So if you proceed to convert just the $6,000 to your Roth IRA for backdoor Roth conversion, 80% of that conversion becomes taxable because 80% of your aggregate IRA is pre-tax. Conversely, the 20% that's after tax means that 20% of the conversion is non-taxable. So what winds up happening is, out of the $6,000 conversion, $4,800 ends up being taxable, 80% of $6,000, which is what we're trying to avoid. Only $1,200 of that conversion is tax-free. So what's the solution? Well, we essentially need to eliminate this IRA altogether. And how can we do that? Well, there are a few options. If the IRA balance is small enough, let's say that it's just a few $1,000, consider just converting it to your Roth IRA and paying the tax. However, it is critical to emphasize the importance of consulting with your tax planner or financial advisor before taking any action. Again, I want to add this as a specific disclaimer. Don't proceed until you've spoken with a CPA or a financial advisor who fully understands how this process works. If you have a small enough IRA, converting it to your Roth IRA helps ensure you will no longer have any traditional IRA assets, allowing you to initiate backdoor Roth conversions in subsequent years without any tax implications. If your IRA has a substantial balance, let's say $1 million, you'll likely want to avoid converting it all at once. A large conversion could result in a hefty tax bill, as the IRS would treat it as if you earned an additional $1 million of ordinary income for that year, potentially leading to several $100,000 in taxes. To circumvent this scenario, there are some workarounds. For instance, if you have a 401k with your current employer, most plans allow you to transfer any pre-tax balance from your IRA into your 401k. Doing this effectively clears out the IRA balances that you have while still allowing you to invest that money. It remains pre-tax and accessible for the future, just in a different plan. Your money is now in a 401k and not in an IRA. So that's one option. If you're self-employed, you can create a retirement plan that suits you. For example, you could set up a solo 401k if you have a legitimate business, and then you could transfer your IRA funds into your solo 401k. The main goal here is, again, to clear out any pre-tax IRA assets. Otherwise, it can complicate things and hinder tax-free conversions. But if you don't have an IRA, or if you can move it to your 401k or another retirement account that's not a SEP IRA or simple IRA or a traditional IRA, then you can use the backdoor method to fund your Roth IRA. So in short, remember these three important points. The first point, ensure you don't have any pre-tax IRA assets before proceeding. This means traditional IRAs, simple IRAs, and SEP IRAs should be cleared out. If you have any of these, the IRS will combine them and treat them as one account. So when you convert after-tax or non-deductible contributions, you're not just converting the non-deductible portion, you are also converting your original deductible portions. It's crucial to note a couple of things here as well. Inherited IRAs are not considered part of the pre-tax IRA balance, which is good. For instance, if you inherit someone's IRA, it won't count towards your pre-tax IRA balance. That's an account that cannot be transferred to a 401k or modified significantly. So again, the good news is that an inherited IRA does not contribute to your pre-tax balance. However, there is an exception to this rule. If you inherited the IRA from your deceased spouse and it's now solely in your name, it's treated as a traditional IRA, not as an inherited IRA. Another issue to consider is whether your spouse has any traditional IRAs. If you're wondering whether your spouse's IRA, simple IRA, or SEP IRA affects your ability to execute a backdoor Roth conversion, the simple answer is no. While it could affect your spouse's ability to do so based on the steps we're discussing, it doesn't impact your own eligibility. Therefore, if one spouse doesn't have any traditional assets, only that spouse would be able to carry out a $7,000 backdoor Roth conversion, or $8,000 if both spouses are 50 and older. Point 2. This involves funding the non-deductible IRA and converting immediately. Some individuals wonder whether they should start saving monthly to an IRA, understanding that they won't deduct any contributions, so that they can invest along the way and then convert it to a Roth IRA once the full $7,000 of contributions is made. Ideally, I don't think you want to do this. When you execute a backdoor Roth conversion by putting $7,000 into your non-deductible IRA and then immediately converting it into your Roth IRA, there are no taxes due. However, if you make a $7,000 contribution and, for instance, invest it, allowing it to grow to $9,000, by the time you convert it to your Roth IRA, you're essentially converting $9,000. In this scenario, the $2,000 of growth is entirely taxable, whereas only the initial $7,000 contribution remains tax-free. Ideally, we want to aim for all of the growth to occur within the Roth IRA. That's why it's really preferable to avoid growth within the IRA itself. Instead, it should really just serve as a funding mechanism to facilitate the contributions, conversions, investments, and ultimately benefit from tax-free growth in the Roth IRA. Lastly, the third point I'm going to make here is it's critical to remember to file the Form 8606 with the IRS. Link in the description below. This form tells the IRS that the contribution that you made to your IRA is non-taxable. By doing so, when you perform the conversion, the IRS doesn't perceive it as a taxable conversion. They'll view it as a tax-free transaction. Once again, it's essential to consult with your CPA and your financial advisor. While this strategy can be highly beneficial for funding Roth accounts even with high income, it's critical to ensure that you're following the correct steps. Here's the bottom line. Executing a backdoor Roth conversion can be a powerful strategy for accessing Roth accounts even with a high income. By following the steps outlined in this video, you can potentially benefit from tax-free growth and enjoy the advantages of Roth IRAs. However, it's vital to proceed with caution and seek guidance from your CPA or financial advisor to ensure that you are compliant with the IRS regulations and optimize the benefits of this approach. With proper planning and execution, the backdoor Roth conversion can serve as a valuable tool in your financial toolkit for achieving long-term wealth accumulation and tax efficiency. Did you know that navigating the uncertainties of the market and your finances are generally smoother and less stressful with the support of a portfolio manager? Studies have consistently revealed that individuals who work with advisors tend to accumulate up to 3 times higher net worth on average and exhibit higher levels of happiness and lower anxiety than going it alone. Do you want to know more about increasing your Social Security and other great financial concepts? Well, click here to learn more amazing strategies. We'll see you soon.